Just before I start getting into it, I just want to briefly acknowledge the traditional owners of the land that we're all working on today and pay my respects to elders past and present. All right, from there I will jump in. Just slides to work. So today's agenda is really, I'll jump through what's new in the accounting standard financial reporting landscape, have a brief look at future changes that aren't the last two major ones, which I'll pick up at the end. I'll do a quick recap on related parties and some of the issues we're seeing there, and just, I guess, reinforce some of the recommendations we've made before, if you've been on this call before. I'll also then jump into and give you a little bit of an overview of where we're at with sustainability reporting and what's coming there. At that point, if you're a for-profit and you are not interested or following or part of a board or anything to do with not-for-profits, I would suggest you can jump off the call at that point in time. Tier 3 is the last thing I'll talk about. It is purely not-for-profit related. So please feel free just to jump off if that's you. I'll give you a shout out for those sort of late joiners as well at that point. All right, so jumping into what's new for 2024. I guess as the heading says, it's not a lot. Why is that? Well, the reality is that the AASB, Accounting Standards Board, the Auditing Standards Board, and Treasury, it is all about sustainability reporting at the moment, and the AASB is all about that and Tier 3. So we haven't got a significant number of new changes pushing through. There is some new accounting standards around insurance and a few things like that. I really don't think it's applicable to anyone on this call. If it is, it's complex and it's a one-on-one type of discussion you'll need to have with us or other advisors. So I'm going to jump through the main things, so the main few things that have changed. So the first one is there's a new statement that will form part of your financial report if you're a public company. So that's listed, unlisted, public, and also some companies limited by guarantee, but it's going to be a pretty small group of you, but I'll explain who that is. And you'll need to prepare what's going to be called a consolidated entity disclosure statement. It's all about disclosures around the tax jurisdiction and the relevant tax jurisdictions of your consolidated group. So these changes will apply for 30 June 2024. The Corporations Act was amended and that got through and royal assent in April. So this is pretty new. It applies to, as I said, listed, unlisted, public companies. Companies that by guarantee are public. However, if you're reporting to the ACNC, so if you're an ACNC charity, you will not have to do this. So it's only companies limited by guarantee reporting under the Corps Act. And then it would only be if you have a consolidation. So you have a subsidiary. So we would have a few company limited by guarantee type clients who are peak bodies and therefore paying tax under the principle of mutuality. If, for example, you controlled a New Zealand subsidiary, you would be required to do this consolidated disclosure statement because you are a taxable entity paying, even though you might not be paying tax, but a public entity reporting under the Corps Act who's a consolidated entity. So there's a chance that a not-for-profit gets in, but really it's targeting listed, unlisted, for-profit public entities. What does this statement look like? So here's an example of it. It will be probably a separate statement as opposed to a note, and we expect to see them really at the back end of a set of financials. I don't think we'll say profit loss balance sheet, this statement. I think it will be at the end. And really, as I said, it's about who is in your corporate group, where are they, what type of entity are they, being body corporate, which probably means company or some other type of entity. You can see trust, partnership listed down the bottom of this screen. What's your ownership interest, and then what's the tax residency of all the various entities within your group, and then also so that foreign jurisdiction, where are they registered? The whole idea is to get some transparency around where organisations have various tax residencies, looking out for minimum tax arrangement countries and things, jurisdictions and things. Within the director's report, this will also then be referred to. So the director's declaration will say whether the consolidated disclosure statement is true and correct. It's a little bit different to true and fair, and so it really has to be complete. So there's no concept of materiality or those sort of things in this statement. It's meant to be a full list, including dormant entities, if you like, as well. In addition, if you're a listed public, I think there's many of them on this call, but if there are, your normal CEO, CFO type sign-offs will need to the board of a listed will also need to include that. And the new statement subject to audit. So the auditor signs off, they're signing off true and fair, whereas the director's signing off true and correct. So there's a little bit of nuance there. So that's the new statement. The second thing I want to touch on is the changes to AASB 101. And that's in relation to the definition of non-current liability. So that changed and is effective from 1 January 2023. So you can still early adopt, and we're seeing some early adopt. What it does is the previous definition of when a liability could be considered non-current, what part of that definition required that you had to have an unconditional legal right to defer. The changes remove that word unconditional. So no longer does it have to be unconditional. The reality is, in most contracts, there's very rarely an unconditional right. There's obligations on behalf of both parties. Similarly. What does that mean? In Australia, that actually will have an impact. Our banks included sort of annual review type clauses and clauses which meant they could change the principal amount that you're allowed to have based on an LVR or other type of arrangements. And so those clauses meant that often, or it wasn't uncommon, for full liabilities to be disclosed as current, even though our clients or you thought you had a multi-year agreement, and in fact did have a multi-year agreement with the bank, because of their rights under those agreements, we ended up in current. Now, a number of our clients didn't like that, but that was the correct treatment under the accounting standard, and we have seen banks activate those clauses as well. So there was some commercial reality to that also. But under the changes, it's far more likely we'll get your multi-year agreements will be in non-current going forward. Where they've also clarified within 101 is around breaches and banks indicating that they're not going to take any action into a breach, and the timing of those can be quite important. And so there's some new examples that have been clarified in 101. So just be mindful of that if you have covenants that you may breach or likely to breach at 30 June, and you're concerned about that current non-current classification, I suggest you reach out to us or jump into the accounting standard reference team. I should have noted at the beginning, we'll send out these slides as well and recording as well to anyone who today wants to register. In addition to that current non-current classification, if you early adopt, and when this change becomes effective for everyone, there is some additional disclosure requirements around covenants and the nature of the covenants and whether you've complied with them, and also if you have facts and circumstances that indicate you may have difficulty in complying with them. So that's quite subjective. But it would be looking at how close you are at the moment to any of those covenants, your forecasts, the reasonability of those forecasts, etc. So if you've got potential to breach, there's some disclosures around that. So that's quite an interesting change. And I think the final change in relation to the current period is there's a change of what used to be called significant accounting policies has been changed to that requirement to disclose those, and that's all the notes. So note 1, note 2 within your financial statements is a whole list of accounting policies. It used to be significant accounting policies, now required to disclose material accounting policies. And what that really means, I guess, as a minimum, it means we probably should change the heading. Our reference to that in the audit report will change to call it material accounting policies. But the underlying concept behind it is no longer what might be significant to you. So where you've got significant transactions, what's the accounting policy there, which are really replications of just what the accounting standard says quite often, to really what's material. And so if it's only material, if it could impact the user's understanding of your financial statements. And so the requirement to explain or replicate what the accounting standard says, where there's really no accounting policy choice, has been removed. And so we would expect to see some of the sort of probably older style templates where we've got things like, here's how GST works in Australia, and, it's applied to transactions, etc. I think everyone knows. And so there's really no requirement to put that sort of thing in. I would note for the not-for-profits in the room, I think there is a bit of a balancing act and maybe the for-profits as well, where you think about who's going to read these financial statements, who are the users? Is it helpful for you to maintain some of those accounting policies, which really help tell the story of what financials, the financial performance for the organisation has been, with reference to the user's understanding of the accounting standards, rather than an assumption that they have a detailed knowledge of them. So I think there's a bit of a balancing act, in and around this change. I would note a couple of other things. So it has been a change. So in relation to financial reporting, just note the change for Victoria and the corporate associations. The thresholds are aligning with ASIC and ACNC from 1 July 2024. So after this year, those thresholds change, and also some stuff around fundraising. We're slowly seeing some changes there. For example, Queensland has made some changes, a bit slower than some of the other states around this, but really you only need to notify if you're an ACNC charity. So it's good to see some of this other regulatory framework really aligning and reducing a little bit of red tape there. So they're really the current things. So if you've dialed in today just to hear what's changing this year, what do I need to know? You can jump off the call. I'll be slightly disappointed, but you can. I'm going to jump into and talk a little bit about what's coming. Again, it's going to be about sustainability in Tier 3, which I'll touch on later. But the one other thing I did want to talk about was what's coming down the pipeline is IFRS 18 has been developed, and there's some new, and what it does is replace 101. So AASB 101 is the foundational accounting standard. It tells you what a balance sheet should look like, what's included, what's in profit and loss, some other core disclosures. We talked about the definitions of current and non-current. That's all in 101. So the key changes in IFRS 18 when it replaces 101, which is likely to be from 1 January 27. So for June year ends, it's going to be 30 June 28. But you can early adopt, and I think we will see some early adoption, is that the structure of the profit and loss statement changes. There's some required disclosures around performance managers, and there's some enhanced guidance around the principles of when you aggregate items together versus when you disaggregate them in relation to the primary financial statements, being the profit, loss and balance sheet, cash flow, but also in the notes. So there's some clarification around that. The core change is the change to the profit and loss statement or the income statement. You'll see that it looks far more like the cash flow. And so we have at the top what is P&L items that are operating in nature. And then we have a couple of other categories where we then have investing activities. So that's income from investments and interest income. And so the profit and loss before financing, if you like, before those financing, which is the bottom category, is really the equivalent of EBIT. So we get that sort of traditional performance measure subtotaled in there. And then interest on borrowings, lease liability interest, other interest expense gets you down to profit before tax and then profit after tax. So it looks a bit like the cash flow statement, but it's a little bit different. So the categories are not exactly the same as the cash flow, even though they're called the same thing. So investing activities in the profit and loss is your P&L items from investments. So where you've got investments in equity type investments or term deposits, other types of investments, that's what's going in your P&L. Whereas your investing in your cash flows will also include items where you're investing in PPE, for example, property or plant equipment. So that's an investing cash flow. But the depreciation expense on that PPE investing, or that PPE type investment that you've made, that's an operating expense. So if I go back in that P&L item, we don't get to EBITDA anywhere. We only get to EBIT. So there's some nuance there that it's worth thinking about. Have seen a number of our not-for-profit clients particularly, but also some of our for-profit clients looking to break out and get some different subtotals into their income statement, particularly those who have share or investment portfolios, and that fair value movement distorts their result. And they want to just show that as a below a sort of a subtotal line, and we've seen that quite commonly. So this will help in relation to disaggregating the P&L and making it more understandable to users. So I think that one's an interesting change, but I don't think it'll be too hard to implement either. I wanted to spend a little bit of time just updating you, going over related parties again. So related parties transactions continue to be in the news, get attention, particularly in the not-for-profit space. I would note that really anyone who is a charity or a for-profit that is required to report either to ASIC or the ACNC, really you have a related party requirement. So related parties, if you're preparing a general purpose financial report, you're already complying by definition. General purpose, complying with all the accounting standards, and therefore related parties you should already reporting. As of last year, the ACNC charities also came into this regime where the regulations were changed to say medium-large charities need to report in accordance with 124, which is the related party standard, in their annual report. There was an exception, and that's for key management personnel remuneration. So if you're a medium charity, which is a charity with revenue between 500,000 to 3 million, or if you're a large with only one remunerated key management personnel, that key management personnel, there's a definition in the standard around those that control really the strategic direction and decision making of the organisation. That if you only had one or you're medium, you didn't have to put that disclosure in. So there was a bit of we've seen some, just note that if you're small charity, so less than $500,000, still required to report some related parties in your AIS. You should have seen that. Basic religious charities, they don't have a reporting requirement. However, if you choose to report, you need to comply with the requirements on that previous slide. So at least comply with the medium level requirements. We've talked about this one before, but what does that mean? We have seen a number of this being challenging for some of our clients around sensitive information, information perhaps not caught to the extent or recorded and understood to the extent that we thought it would be internally. So whether you're for-profit, not-for-profit, it's probably important that you have policy and procedures around dealing with related parties. So the ACNC would recommend that. They've got some examples of policies around that, but really your policy should provide you with a control type framework where you ensure that your related party transactions are identified, authorised before you incur them, and then they're documented or recorded so you can easily disclose them within the financial record. Some of our clients are dealing with this in conjunction with conflicts of interest. I think that's possible, but your conflicts of interest policy probably needs to be extended a bit because conflicts of interest is about managing a conflict at board level, whereas related party transactions might not necessarily go through the board level process for authorisation every time. So if you use a conflicts of interest policy, you need to make sure it's sufficient to ensure that your related parties are identified, again, transactions authorised, and you capture it for disclosure. In our view, you will need a register to do that. the ACNC has an example of one. We can also provide you an example of one. If you just email us, we'll shoot it out to you. But it takes you through takes you through the various types of potential related parties, and so it helps you to think about related parties in a holistic manner as required by the standard, rather than a broader category. So there's an example. It just looks like that. Practical issues with related parties. We've seen conflicts of interest registers and those sort of things often sit up at the board level. They may not actually get communicated down to the finance team and that sort of level. The reality is it's that level that are going to be capturing the transactions for disclosure and need to be aware of who are the various related parties, being spouses, spouse of board members, for example, or children of board members, or organisations, companies that board members or their spouse control, so have a majority shareholding in, those sort of things. They may not be aware of them all. And so it's important that there's communication of this, and that there's access to documentation to enable the details to be that are required to be disclosed to be captured and disclosed. Do note that in the not-for-profit space, donations, things like that, are by definition related party transactions. We note that materiality applies. So how do you understand whether you've got a disclosure around donations from board members or from the board members as a whole, for example? It's perhaps an understanding in the minutes of a materiality threshold, and there's a confirmation that no one's given more than that, for example. So I think there's some practical ways to work your way through the requirements of the disclosures. I would note that confidentiality sensitivity is not an out under the accounting standards, and no provision for if this is confidential, you don't have to disclose. So we really need to deal with it in the way you word the disclosure that you're trying to make. We try and, where possible, not include amounts where we can point to an award or some other form of remuneration, for example. If someone's son or daughter perhaps is employed within the organisation, we also try and leave names out of related parties where we can, but where that may not always be possible. So again, I think the best way to think about it is put in place that framework, make sure you capture them, understand what they are, and then as us as auditors or your auditors or reviewers, you can talk about, well, how can we disclose this in a way where hopefully you can maintain a level of sensitivity, but still meet the requirements of the standard. So identify early, have an early discussion with your auditor is a great starting point. All right, I'm going to jump into sustainability reporting and just and talk about this. So this is a pretty high-level overview. I'm going to look through in the next 10 minutes or so around sustainability reporting. It is not something that we're holding ourselves out to be, or holding myself out to be a real expert in this yet. We've got some learning to do internally here, but we're on a journey with that, and there's probably a number of you on this call who will need to start that journey as well. So what am I talking about? So sustainability, well, where have we come from? I've got Lightning McQueen on the side there, and that's because this is undoubtedly the fastest set of accounting or reporting standards and assurance that goes along with it. So auditing, reporting, accounting, financial reporting, and auditing assurance standards that we'll see in our lifetime. So it was only January 24 that the Treasury released draft legislation around this that mandates climate-related financial reports. What the financial disclosures? What does that mean? So climate-related means carbon emissions. Okay, so we're not talking about mandated reporting around things like biodiversity or endangered species or those, the number of other things around land clearing, that sort of stuff, the number of other things that would be included, recycling, etc., that would be when we think about sustainability, we might include all those things. This is very narrow in it's about carbon emissions or, in effect, greenhouse gases. So that's beyond carbon, obviously. But what the proposals are, which have got through the lower house of parliament so far, are that there's mandated disclosures for large business and financial institutions. It will be done so in a separate sustainability report. It's going to be based on those international standards, but climate focused. So the international standards are actually more broad than what Australia is adopting. As I said, it's only about carbon emissions or greenhouse gases. And it does require assurance, so there is an audit. Why? The government's saying it supports mainstream investment decision making. So just like mandatory financial reporting for large organisations has been around for a long, long time, around investment decision making, etc., they're saying sustainability has the same driver. It will provide globally comparable information around sustainability-related risks and opportunities, or carbon-related risks and opportunities, greenhouse gas, climate change type issues. At the moment, we don't have that comparability. So we see a number of organisations, there's some legislation for MANGAs and EBRS, where the top emitters in Australia have been reporting under that for multiple years now. But outside of that, you see a lot of sort of sustainability reports being done really voluntarily, particularly at the listed company space. But they're different. They're all a bit different in the way what they include, what they don't include. Is it subject to assurance? All those sort of things. So the current framework or landscape is really fragmented, voluntarily being prepared. And so it'll bring consistency and also mitigates greenwashing. So ASIC have been, the last couple of years, been talking about the appropriate and reasonability and balanced disclosures within the sustainability reports that listed companies are making voluntarily. And they've been concerned about greenwashing and have named and shamed a little bit there. And so they're talking, they think this will help mitigate that. So, probably scared some of you, who needs to report? So it's only organisations that are reporting under Chapter 2M of the Corporations Act. And then there's various categories. So the majority of small to medium-sized family-owned orgs don't fit into this. I'll talk about charities in a moment, but you'll be pleased to know most of you will be exempt from the mandatory reporting. So we have Group 1, which is 1 January 25. So from 12 months from the start of draft legislation and proposals being implemented to you've got to start reporting, recording and reporting from 1 January 25, very short period of time. But this is really for the big end of town. So 500 million turnover, $1 billion in assets or more than 500 employees. So 2 or 3 of those thresholds. So that's Group 1 who will kick it off. Group 2 a year later. Again, those lower thresholds, as you can see on the screen. And then Group 3 is what is currently the large proprietary limited company reporting thresholds, financial reporting thresholds. They're adopting those. There are a lot of those. So that maybe has highlighted or brought some of your eyes have just opened quite widely. I would note some exemptions. So again, it is only organisations reporting under Chapter 2. So that does not include ACNC registered entities. ACNC registered entities, no matter what your size, you're reporting under the ACNC Act. Even if you're a company limited by guarantee and you're ACNC registered, that part of the Corporations Act in effect got turned off. So you don't report there. So you're automatically, all ACNC charities, no matter what size, are out. However, if you are a charity or a not-for-profit that's not reporting, that's not ACNC, but you are a company limited by guarantee, you will be caught under these provisions if you sit within those thresholds that were on the previous. If you have some of the exemptions through class orders around reporting, etc., it's likely those class order exemptions will apply for sustainability reporting also. So that's who's definitely in and out. I would note that for Group 3, so that's the lowest end group, it doesn't apply till 2027. If you don't have material climate risk and opportunities, you don't have to do the full report. You can disclose a statement explaining why you don't have those risks and opportunities. Now, there's some discussion around, well, who would be in that group? There's potentially some, came out in front of sort of some of the parliamentary committees and those sort of things as this was being developed, that perhaps up to 95% of this bottom end tier at the bottom here would not have those material risks and opportunities. And so what we're waiting for is really to get some guidance around, well, one, the legislation passing out the House, but secondly, what is material and how would you make that assessment? And I expect to see some real understanding around that. I think it will mean that I don't think it'll be a really high level assessment. The conversation, current thinking is that may have some detail, it may have some measurement metrics in it around greenhouse gas emissions, etc., the type of markets you're in, and an analysis of risks and opportunities to explain why, as opposed to just a statement. And I would note that the current proposal is that there needs to be assurance on that statement. So an auditor needs to agree with you around those risks and opportunities. So I think there's a bit to play out and a bit of understanding to be developed around that criteria. But I think based on that, I think most of you on this call would probably be exempt or would likely fall into that materiality exemption. But there may be some of you who are thinking you probably don't. So what is a sustainability report? It's similar to the financial report. It will focus on governance and strategy. So that's a bit like what the front of an ASX listed annual report has, that big director's report, chairman's report, and those sort of things. They often talk about governance strategy. And then it will need to talk about, or has disclosures about material climate risks, controls and risk management around how you're managing those risks, and then disclosures on emissions, which are broken up into scope 1, 2, and 3, and I'll talk about what they are in a minute. So that'll have notes to the climate statements where there's extra, basis of preparation and key assumptions or processes used, and we'll include a director's declaration, and on a phased-in scale, we'll include some sort of assurance. Part of that will be review assurance early on before moving to full style audit assurance, which I'll update you as that legislation passes, etc., and we get real clarity around what that timeframes will look like. I'll update in the future updates. So what are scope 1, 2, 3 emissions? So I've got a couple of slides on this to try and illustrate it. So scope 1 emissions, they're your direct emissions from burning fossil fuel. So where you've got a fleet of vehicles, etc., you're burning a fossil fuel. So therefore you would have scope 1 emissions. It's also sort of emissions from building properties where you've got gas sort of connected or some sort of greenhouse gas emission on your cooling or whatever. That's scope 1. Scope 2 is pretty much just your electricity usage. And scope 3 are all your indirect emissions. So these are in both your upstream, downstream supply chain. I'll show you another slide that perhaps gives some examples of that. So as I said, scope 1, company vehicles, company facilities. Scope 2, electricity. Scope 3 is in effect, the embedded emissions around any transportation, waste, capital goods, business, employee, travel, to and from work, etc., in and around your leased assets. So that's on your supplier side. And then on your sales or customer side, what's the use of your sold product, the end of life treatment of sold products? Are your products incorporated in someone else's manufacturing / supply chain, etc.? And so Your scope 3 emissions are others scope 1 and 2 emissions. So yes, there is this double counting. This seems like a really onerous thing, and it will be difficult for some organisations. My initial reaction was probably, oh, how are you meant to measure that? But I'll give you some understanding of that. I do note that there's a number of organisations already reporting around this, and so it is possible. Yes, there's specialists involved in some of this measuring through the value chain, but it's not an insurmountable challenge. So just want to give you an example. So if we took a professional services firm, that might also be a charity and disability services space, for example. You're a lot like that. It's an organisation with some revenue streams from customers, and then providing services, some sort of service to customers, and then probably primarily denominated expenses being employees, if you like. So that's my example, as opposed to a manufacturer. So scope 1, it's just going to be building refrigerants, those sort of things, and if you have any company vehicles. Scope 2 will be your purchased electricity, and scope 3 would be your employee travel to and from work, business travel, my purchased goods and services, so maybe your capital goods, your computers, your office, furniture fittings, that sort of stuff, waste generated, and they're probably going to be your key items. How do I measure these scope 3? Well, there is data developed and out there, really embedded within what's an equivalent of an accounting system where you can utilize a spend-based methodology, where if you spend this much on this type of service, say a marketing company, for example, and you spend this much with them, the equivalent level of greenhouse gas emissions for that dollar of supplier, being a marketing firm, would be this much. And so there will be some market-based data out there. Alternatively, where it's significant, large, we'll see organisations requesting information from their suppliers where it's available, or where they have sufficient enough power to demand that it's done, or it'll be industry-based data. So that's how that will work. If you want to do some more reading, there's lots of stuff being produced. Here's the AICD guide. It's a couple hundred pages. It's not a bad sort of read. You can pull that off the AICD website. But if you read accounting your professional body magazines, those sort of things, there's a lot coming out. And the main accounting firms, the large accounting firms, are also doing stuff really targeted at the big end businesses, but worth a read. And I encourage you all to keep up to date around that. Just want to go, okay, what's the impact? So for for-profit companies that are group 3, like I would say, let's wait for the legislation to get passed and get some guidance around how would you deal with the materiality question in relation to, do you have material risks, opportunities in relation to climate or not? And then once we understand that, you sort of have some direction of where you need to start thinking and what direction you need to go in. There's minimal immediate impact on changes. Okay, so not required to. I do note that organisations may need to engage with climate reporting considerations over time, even if they don't have climate reporting obligations. Why? If you are a scope, in effect, a scope 3 emissions for a large business, so you supply to Coles, for example, listed company, they are likely may put pressure on you to get you to report to them your emissions and your impact. And so they can use that in their reporting as the scope 3, or in their calculations for scope 3. So where you're in a supply chain, either of major organisations, you may have a reporting obligation to them, or may get some pressure to start reporting. Likewise, in the not-for-profit space, there's uncertainty around government funders, grant funders, philanthropic funders, whether over time will they start demanding sustainability type information. Certainly seen that trend with other types of information from them. And will it become sort of an accepted part of grant reporting or those sort of things? Don't know the answer to that, but it is possible with large grants. So I think for, if you're getting external type funding arrangement, not-for-profit in the room. You're part of a supply chain of a larger entity. I think the message is still don't assume nothing, but watch this space and maybe start to understand, well, what am I type 1 and 2? What perhaps might my type 3 be? Without measuring, type 1 and type 2 will not be too difficult, I think, to calculate. So by all means, find out who's interested in your organisation and perhaps start the journey around some of this sustainability reporting if you haven't already, or if you're already doing something, think about, well, what needs to change to align to what will become the benchmark. So that's sustainability. Like I said, Matt's there to answer all your hard questions on that one. So type them into the chat. All right, I'm now going to jump on to what's tier 3 reporting. So again, I sort of mentioned at the start, but if you join late, if you're a for-profit and that's all you're interested in around financial reporting, this will not apply to you. It has no application to you. So feel free to jump off the call. And for the rest of you, I'll jump into tier 3, which is quite a significant change in not-for-profit. So tier 3. What is it? It's the not-for-profit private sector, as opposed to public government sector, financial reporting framework, and it's about the removal of special purpose. So for those of you who've been attending these for a while, you'll have heard me talk about removal of special purpose is coming. It's still coming, but it's getting more and more clear as to when that will happen. So there's already been a discussion paper around this released by the AASB, and they're working through and developing a draft standard, which will be an exposure draft, which will be released before the end of this year. So an exposure draft is what the AASB think the standard should be, and they put it out for final feedback. So it can change, but really they only change if there's some sort of overwhelming type feedback about a particular issue or something in that. What does this mean? We expect to see a standard released after consultation period, and then any changes. I would expect to see a standard released by the end of 25 with a likely 3-year adoption period. So you've got 3 years to get ready, but early adoption probably by June 26. So, and I think we will see some early adopters, and I'll explain and you'll understand why. As I work my way through this. So this is about, so who does it apply to? Sorry, it applies to not-for-profit private sector, not just ASINs. Who does it apply to? So charities, not-for-profits, who the thresholds are unclear at the moment. Why is it unclear? I think that's maybe the first thing to address. The reason is it's going to be Treasury who write the laws, so Treasury write the Corps Act, write the ACNC Act, for example. They will decide who gets to apply this new standard. This standard will remove special purpose reporting, but allow for this, what is simplified, an accounting standard. So this will be general purpose, but it'll be general purpose tier 3. Who can apply that will be decided by Treasury. The standard has been designed for the medium-sized charity. So I'm part of the consultation group that meets with the AASB every couple of months. I've been working through this for the last 2 and a bit years around the development of this standard, and it's designed with this, I guess, size charity in mind. But again, the ACNC in some forums has alluded to, perhaps it'll be a higher threshold, perhaps it should be a higher threshold. It is not up to them. It will be up to Treasury. So it is possible that charities, not-for-profits with perhaps 5 million turnover or 10 million turnover could apply this tier 3 reporting, but it wasn't necessarily designed for that. I think it's highly unlikely that it'll be less than 3 million. I think 3 million is the minimum that it'll apply to. And what does this stand for? Okay, so it will be one standard, which talks through a whole lot of various accounting requirements. So you no longer have to have the book this thick, you'll have one standard this thick in effect to deal with measuring transactions, balance, disclose, etc. What are some of the key parts of this standard? So part of it is in relation to what's called opting up. You are not allowed to opt up into tier 2. Tier 2 or tier 1 is just the existing accounting standards in full. So you can't opt out of tier 3 for a part of it. For example, talk about it later, but one of the changes, or one of the requirements within tier 3 will be that leases are no longer booked on the balance sheet with a right of use asset, lease liability. You just expense them on a straight line basis in effect. So back to where we were. But you can't say, oh, I really like lease accounting, I'll apply tier 3, except for that, in which case I'll grab the requirements out of, in effect, the tier 2 accounting standards. You can't do that. You either opt up in full into tier 2 or you're in tier 3. So the only time that you're not following tier 3 is where transactions, events, or conditions are not addressed by tier 3, at which point you apply the principles of tier 3 or the conceptual framework. If there's no principles that you can really apply, you apply the conceptual framework. And when applying the conceptual framework, you might consider how tier 2, what are the requirements of tier 2 or the existing accounting standards in that. So that's the distinction. So you can't pick and choose. You're in tier 3 and its requirements, or you opt up into tier 2. So there's a number of things that aren't going to be addressed in tier 2, and there's the list on that page. For smaller end, not-for-profits, charities, we don't see a lot of these things, and that's why they're excluded. They're just saying they're not going to be many of them. We do see occasional complex financial instrument. We do see assets held for sale, where you have these or have biological assets or agricultural type assets. You opt up and you then apply tier 2 in effect for these ones. Assets held for sale is not a difficult thing, and I think they just didn't want to replicate the requirements out in tier 3, so they just in effect put you up to tier 2 on that one. Some of the big concessions, which I think, I posted at the outset, I think where they're ending up is really pretty good. There is a lot of concessions in tier 3, which will make it simpler and easier for smaller end charities, not-for-profits. So consolidation, the proposal is that it's a policy choice. So if you have subsidiaries where you have either control, significant influence around, you no longer have to work your way through, do I have control on AASB 10, etc. You just have to identify, where do I have what's called notable relationships? And I think they're going to be pretty self-evident. If you have those, you have related party disclosure in relation to transactions, etc. with them, but you don't have to consolidate. You have accounting policy choice either to consolidate or record your investment in those, if you're the parent entity, at either cost, fair value, or you could apply equity method. I don't know anyone who, I'm quite sure why people would. I think most people will record cost. Often cost will be 0. So you'll have a disclosure that you have some notable relationship with these organisations, but they're not in the balance sheet because they have 0 cost. So I think that's a massive concession, but that's really good for this sort of size charity. Its consolidation is complex and has issues. Revenue, it's been really simplified. So AASB 15, which is the current revenue standard, it is complex to work your way through, particularly where you get style funding and those sorts of things. Tier 3, it will enable you to assess a transaction, what's called based on the common understanding evidenced by the transfer provider, being the grantor, the donor, in writing or some other form. Some other form. That evidences the way you're expected to use the resources, i.e. the grant, etc. Where you have that, and I think we'll see organisations structuring their website, donate here, what do you want to donate to? Get really specific about that. You probably get into this common understanding. And then you'll recognise revenue that represents the pattern of consumption of the resources around goods or services transferred, activities performed, or some other systematic basis. So under AASB 15, for example, if someone just said, here's here's a donation, and that should fund the wage of this person for the next financial year. AASB 15 would say that's not sufficiently specific enough. Funding a wage is not an activity for a customer, etc. We'd be saying, technically, AASB 15, that's revenue on receipt. Under under Tier 3, sorry, you would say, well, I've got a common understanding around what these funds are for. As long as that was in writing or some other form, you would then recognise revenue on the basis that you, in effect, paid that person's wage for the next financial year. So you get to matching, which is what a number of our clients and a lot of what the sector really likes to do. They want to match where they can revenue with the relevant expenditure. This opens the door far wider than the current standards. So I think broadly the sector will be pretty happy with that. Leases, as I said before, we're back to the future on leases. So similar to what we used to have in leases, finance leases, operating leases, they won't be on the balance sheet anymore. You just have a straight line expense or some sort of systematic basis. Most people I talk to, and I have sympathy and tend to agree with them, think lease accounting was silly and not understandable by the common users in many not-for-profit spaces. And so this concession, I think, is a total win. Related parties will still be in. So you will still have to disclose related parties similar to what the Tier 2 or the current 124 requirements are. Except if you have donations from a related party. So remember I talked about that before, that donations are by definition a related transaction. But where you have donations from a related party, where you can demonstrate that they don't influence the entity's activities or use of the resources. So where you can show that, really interestingly, I think the AASB have picked up and said, well, you won't have to disclose that. So some of the feedback to the ACNC around the problems with implementing related party transactions and the concerns raised have been carved out. So that's pretty, I think that's a really good resource. Really good concession. Likewise, key management personnel, they're saying, this standard's probably saying not required to disclose. Now that is based on medium-level charities and not required to disclose under the ACNC requirements at the moment. So they've in effect replicated that. But the ED is basically, exposure draft, is going to say, we're going to seek a little bit more feedback on that at the ED stage. So the AASB is hedging their bets a little bit on that one, but that's what the current proposal might look like. Other proposals where you hold financial assets held for capital return and income, you get to elect whether you book the fair value change, so the change in the market value of that through profit and loss, or you can elect to go directly through equity or reserve, which is called other comprehensive income. There's not the requirement, the technical issue around only certain investments can be put through reserve under Tier 2 reporting, and so they've got to be equity instruments. That has not been included in this. So it's by class of interest. So some of those other managed funds, trusts, etc., that are problematic under Tier 2, you can elect either through profit and loss or through reserve. So I think that's I think policy choice is appropriate and a good answer there. There's some simplification around long service leave and the calculation of that, and around pay increases and discounting, so that gets removed. Interestingly, where there's an error or a correction or a change in accounting policy, there's what's called the modified retrospective approach. What that means is you don't change your comparative and you do an opening balance adjustment for that. I find that quite interesting. If you've got errors in the prior period, that you don't correct them, you actually just make an adjustment in the current period. So that's an interesting one. I think they might continue to get some feedback. That was a little bit contentious. There was some debate around that one in the meetings I attended with AASB on that one. Other proposals, accounting policy choice, where you get an asset, a non-financial asset, significantly less than fair value. What that means. someone donates a property to you, leaves a property to you in a will, for example, and you actually physically get the you get to either measure that at cost, which is likely to be nil or not much, or fair value. So I find that one quite interesting. I probably fell on the, if it's material, you probably should record it at fair value. Interestingly, whether if it's property, for example, if you adopt a cost model or a revaluation model, that doesn't impact the decision. You could still initially recognise it at cost, which means nothing through the profit and loss. If you use that property for the charitable activities, so it's classified as property, plant, equipment, the revaluation just goes through reserves. So you get this big item potentially that doesn't hit the profit and loss. However, if you are recording these assets at cost or amounts significantly less than fair value, you do have to disclose where you're reliant upon that, or where you've got significant amounts, so the users understand this. Personally, I think you just book it, but you're able to not. Personally, I think book it at fair value, but cost is looking like an option. Interesting to see the feedback again on the ED on that. A few other things in relation to loans, interest-free loans, etc. They're making that simple. There's going to be a simplified impairment test around assets. So they're only going to be, you only have to do an impairment test. So write it down. That's what that means. If they're really damaged or their use has been adversely affected. So otherwise, you don't have to. Some other ones that are straight hot off the press, released by the AASB a day or two ago. Business combinations, so more likely think merger for many of you. So merging your organisations, you're able to pick up the accounting carrying value of the entity that you, or the business you take over. So if all the assets and liabilities are another not-for-profit transfer to you, you can just book them at the book values. You don't have to go through a fair value assessment. So that's a significant change. Also, if you form a new entity, so let's say you bring two entities together, form a new entity, you can actually show in your comparative period, in effect, the consolidation of the two entities that came together, which is a really interesting proposal. So I'm not sure whether organisations will take the time and effort to do that, but we've certainly seen some organisations try to do that under a special purpose framework, and the ACNC have allowed it when we've spoken to them. So it doesn't really make sense under the way the accounting standards are written, but that's an interesting one as well. And the third one, or the last thing around this, is in relation to intangibles. So think goodwill, IP, other sort of intangible assets. Internally generated have been prohibited for a while. So goodwill has been prohibited, but it's going to prohibit the recognition of internally generated intangible assets. So if you're developing an intangible internally, they're going to say no. And likewise, indefinite life, which was traditionally goodwill, but it can be other things. They're saying, no, you don't carry them forever, you amortise them over 10 years. So there's some real significant differences between Tier 2 intangibles. And then some impairment testing around triggers for that, which are different as well. But if you're amortising them down over 10 as a max, I think the impairment issue probably goes away to a large extent. So that's Tier 3, what we know about Tier 3. They're doing the technical end of the standard. They are the key differences, I guess, that I think we'll see. In relation to other not-for-profits, and I'm nearly done, I know I'm just going slightly over. What about entities that are above the threshold? So I've asked this question of the AASB. I haven't got much of a response in reality. In reality, I think you're going to be stuck with Tier 2 simplified disclosure from 28-29. So that means consolidation, means compliance with 15, compliance with leases, compliance with disclosure requirements. So that's where that's sitting. Again, don't know what that threshold will be, but if you're our client, I think we've been probably talking to most of you about what that might mean in our management letter, etc. But as this sort of plays out over the next year, it's going to be important that you understand the implications and what can be done. Some of you will have tracked with me around consolidation, AASB 10 before. I'll just give a brief update. There was a post-implementation review. That's what PIR means in relation to AASB 10. Feedback was March 23. The AASB has not got to it because of these other things. So they are meant to consider that at the end of 2020, second half of 2024. This is about who gets dragged into consolidation in the not-for-profit space. I think there's real issues around that. And we've shared our view quite strongly with the AASB, continue to do so, but we should start to see some movement on the AASB around the end of the second half of this year, in conjunction with the removal of special purpose and the implications of that. They need to address this issue, and we keep telling them they need to. What the outcome of that will be, I don't know, but we'll certainly keep you informed. We understand it's a big issue for a number of our clients, particularly in the faith-based religious space. All right, that's pretty much it. So I'm going to maybe stop sharing my screen and look at some of you. And Matt, are there any questions, things you wanted to highlight or ask me?
No, thanks, Jeff. Your presentation was super clear. There's no questions, but yeah, if anyone did have any questions, please feel free to call us or send us an email if there are any questions as you digest some of this information over the next period of time and consider the implications for your organisation.
Right. Thanks, Matt. Thanks, everybody. I'll let you get on with your lunch. Really appreciate you attending. Like Matt said, if you have any follow-up questions, please don't hesitate to reach out to us, and we'll shoot out the recording to you over the coming days. But otherwise, enjoy your day, and thanks a lot.